Welcome to another episode of Purchase to Profits. I'm Seth Ferguson. Make sure you hit the subscribe button so you don't miss our daily interviews with successful real estate investors. And I've put together the top 7 key market drivers I look at when analyzing a real estate market. Go to sethferguson.org to download your free copy. Our guest today has $12 million invested and committed on current projects in DC, Atlanta, and North and South Carolina, with a company revenue growth exceeding $11 million. John Rubino is the founder of JID Investments. John, welcome to Purchase to Profits. It's great to have you on the show.
Seth, an honor to be here. Thanks for having me. I appreciate it. I'm looking forward to having a great conversation and having a chance to share with your listeners.
Yeah, really looking forward to this. So let's dive right in and talk about your real estate goals right now and where you want to go with real estate.
Sure. So I've owned my company for about 6 years. We started back in 2013. I'm a 20-year Navy veteran, and I got the chance to start my company while I was still in part-time, which was great. Gave me the opportunity to experience the highs and the lows, as well as, still getting a paycheck from the Navy, which was great. But I knew that that was my next chapter after the military. Was really, I wanted to go out and be an entrepreneur. I wanted to be in real estate, been in real estate for 15 years. And so my goals have always been to take a look at what opportunities are available through my experiences, through the people I've met, through the things I've done in real estate. And my goals continue to be growing my business in a way where I can bring in more accredited investors that like what we're doing, see what we're doing, have the opportunity to take a look at specific projects we bring in for investment. And at the same time, not only being an owner of the business, but as an investor, I'm also interested in seeing the types of projects that we like to look at. We're a pretty unique company. We're an alternative investment company where we look at everything. We look at long-term, we look at fix and flip, we look at condo development, mixed use. So, the sky's the limit. If it meets the parameters, it's a good sponsor we're comfortable with. My goal is to continue to just see how we could continue to partner with those types of folks to bring those types of opportunities to our company. And then as I continue to grow, I'm interested in learning more about being an independent investor, looking at different types of opportunities that meet my portfolio of risk and what I'm interested in. So as I continue to grow my business and we continue to grow in revenue, obviously I have the opportunity to then look at some things individually. So my goals continue to be to grow my business in a nice, comfortable way. And at the same time, as I get a little older, start to look at what opportunities will be available for me to utilize my revenue and my capital to invest in certain types of areas and projects.
Yeah, I found it interesting that you said that you're really wide open with what you'll consider. That almost goes against the grain of what other people will say. You got to focus on one thing and do that one thing only. And whereas you're taking that that wide open approach, what led you to go that way versus focusing on that one asset?
Yeah, so like I said, I've been investing for 15 years, and I started as a rehab or a fixer flipper, going out and finding smaller projects. It was about 2005, 2006, so just right before the recession hit, and I found my groove really in larger scope projects, just because not a lot of people could participate. Cash was king at the time. And now where we're at in the real estate cycle, we're kind of in that same area again, like right before the recession. Knock on wood, we don't have another one, but we still have to be prepared. So I think, just like in anything in life, you don't want to be a one-trick pony. You don't want to have just one specific thing that you do, because if that area gets hit during a correction or a recession or a change in the environment of the economy or in real estate, I think there needs to be other things to look at, whether it's, hey, I want to get cash flow now because opportunistic deals are not prevalent given the environment. Now it's more core or core plus, right? So that's kind of why we're opening the spectrum, so that if we have 8 opportunities out there, 8 different types of investments, we get to pick and choose, which makes sense given where we are in the cycle, where the risk is, what's the location, how do we mitigate the challenges of the project, and still get us the type of yields and returns given that specific opportunity that our investors are attracted to.
And how do you set targets for your growth? Because I know you said you wanted to grow, but not, grow at a comfortable pace. How do you set targets for year over year, or do you have that 5-year goal? How do you wrap that in your head?
Well, we're still a small and growing business, even though we've been in business for 6 years. We've had a lot of success. 6.5 million of actual completed investment with 2.25 million of revenue across 15 amazing projects. My philosophy has always been crawl, walk, run. I always want to start out in a way that it's manageable, it's conservative. We have almost $13 million on the street right now. And that's a lot of money. We have 120 investors, and so 6 projects, 12 million, 13 million in investment capital. That's a lot to leverage, and especially where we are in the cycle. So I just want to make sure that we take sizable and easy small chunks on the bite instead of over leveraging ourselves and getting caught up in the fact that, hey, this is never going to end. We know there's going to be a down cycle, so we just want to be postured well with the deals we're in to make sure that if we do hit a bump in the road, we're still going to do well. And at the same time, keeping our eyes open, but being cautious, being conservative, and being smart about what we look at. Again, we're basically looking at investments at location, the developer's experience, our comfort, and then really it's just a matter of, hey, does the due diligence line up on the deals we look at?
And what sort of advice or tips would you give somebody? Because you've been in the business for a long time and you've seen the different phases of the cycle. Lots of people now, they haven't experienced that downturn. So what sort of advice would you give them in terms of preparing for that and what to watch out for?
Yeah, so me personally, there's 3 things I believe that, are factors or variables in any deal, right? The first is acquisition. The second is construction and cost, and the third is appreciation of the market. Well, there's really only one of those variables that you can control, and that's really acquisition. You can come in and you can dictate terms for purchase. A lot of people right now are getting very aggressive. They're going out and buying things with the mindset that, oh, the appreciation is going to continue to grow. We're going to have 10, 20, 30% growth. And if you look at the statistics, you look at where we are in the cycle, odds are that there's a smaller percentage of that than a greater percentage of what it's probably not going to happen. So construction costs are only getting higher. They're only getting more expensive. The economy is booming. Labor is very expensive. So in my mind, the biggest thing I look at is, what is the developer purchasing the property for? What is he getting it, or what is she getting it for, given a loan to value or loan to cost on what the value of the property is? And if they can get in there and they can get that property at 20, 30, 40, 50, 60% of what it's worth in valuation, then that's great, because now they've come in and they've given themselves a huge advantage when it comes to the purchase, and it allows them then to still have comfortable margins on their construction and still plan on a conservative appreciation. We love to hit our projections or go above our projections, and we've done that on pretty much 99% of our deals. But if you come in and you over leverage yourself, or you're going in at 75+% on your debt, you're buying properties at excessive value that greater than what the value is, it's gonna bite a lot of people. So that's something I look at. So I would recommend people that are in my type of business, who are either syndication companies or investors, when they look at the deal, look at the upfront costs. If you're looking at a sponsor, look at their fees. Look at what they're buying the property for. How much money are they bringing to the table in order to take the deal down? And what is that then going to do for the life cycle of the deal? What's going to happen when it's, construction calls come in, and then there's capital calls, and they're like, holy crap, we planned for 10% construction contingency, but it's been 20%. Or when the economy maybe takes a hit, and now appreciation, which was scheduled to be at a 30% growth, is now only at a 10% growth. So these are the different things I'd recommend folks look at.
Yeah, no, those are definitely some really good tips. And what would you say is your biggest challenge right now in your business?
Wow, that's a good one. So let's look at it. Being in the military, I have 3 levels. There's the tactical, the operational, and the strategic. On the tactical level, it's just really keeping up with the deal flow and the communications between what's coming in. Obviously, we like to work with developers and sponsors we've worked with over numerous deals. If you have a great sponsor and they're bringing you more projects, that's great, because your investors have a track record with them. You have a track record with them. There's a really good, comfortable way of doing business together. So that's great. The other thing we're looking at is just, how do we get our arms around the next changes? What are we looking at from the cycle? How does that impact our deals? And again, now I'm looking at multiple exit strategies when I look at a deal. I don't look at just, hey, what's the goal, but what is the contingency of A or B or C? Can we shift from a sell to a hold, and then what does that do to us? So that's kind of the tactical level. The operational level is, how do you manage investment relations, project relations, business development, marketing and advertising, answering emails, being the janitor, turning the lights on. Those are all the different things as a business owner. And it's just me and my partner. How do we manage that together with the kind of day-to-day routine of the business, and just kind of making sure. So right now we're really focused on bringing in more investors. We want to have investors who are available to look at our deals, to have the opportunity to determine if it's a good fit for them. And the nice part about us is we don't ask anybody for anything when they become an investor. We just want them to see what we're doing, and if they like what they see what we're doing and they want to subscribe to a deal through a private placement, that's great. So we make it very friendly, interactive, easy to come on board to see what we're doing. So that's the operational side. The strategic side, just like with any business, is as you grow, it's really a question of, hey, do I want to sit where we're at and just kind of ride the wave and feel good about what we're doing, maybe do 2 or 3 deals a year, or do we want to become a larger a business, corporation? So now it's, do I want to start bringing in advisors? Do I want to bring in consultants? Do I want to bring in a team that can help us as we grow? Because, you're smart about things and you like doing certain things in the business, but at the same time, there's people out there that are better at it. And then if you bring them in and show them the potential of the growth, and of course, making it mutually beneficial for them, they're going to want to be on board and be hungry to do that. So that's the big challenge strategically, is how do I put the right people in place as we grow? So we just have brought on a due diligence consultant. We have some interns. We're looking at maybe putting our deals on an investment platform, someone that can manage the cradle to grave process for us on syndication. So these are the different things I'm looking at now, so that I have more time to kind of chart the course of the company strategically as the owner, as one of the principals, as we continue to progress with our business growth.
Yeah, and I think you brought up a really good point. And by bringing on those people to your team, you're able to concentrate on those money making activities and the stuff that you're really good at, right?
Absolutely.
So like you said, you're kind of like the captain of the ship, driving it through. And I'm sure with yourself, outreaching to investors and raising capital is one of the most important things any owner can do.
Yeah, absolutely. And as your listeners, as they get to the point where, you obviously get your business stood up, you find out what your value is. To me, in business, you have to find your value proposition. What do I bring to the table that adds value, not only to the sponsors I work with, but of course the investors I'm bringing on board? So I have something of value. I know I do. I add value to my sponsors because I can bring in a level of capital that is either it's less than what institutional equity can bring in, or an institutional funder can bring in. So I have a nice little sandbox and a niche I've carved out. So I add value to my sponsors. I add value to my investors because I can get them the type of yields and returns that are very attractive, and in a way that, I can't guarantee it, but I protect their money. I protect their security, give them comfort knowing that, hey, there is risk, but John's on it, David's on it, and they're all over it, and they're going to do a good job for us. So that's constantly in my mind as I'm thinking. So as your listeners think about, hey, how do I get started in syndication, or how do I get started in real estate? It's find your value proposition. What could you bring to your clients, your referrals, the businesses you work with? And then from there, just grow on it, because that's your core, right? Just like a spider, it's the middle of the spider, and then the legs are just going to branch out. You're going to find ways to grow the business, websites, all that other stuff will come into play. But if you have value, you need to expose that and make sure that people are aware of that. And then, of course, educating, communicating, and informing folks, being able to come on a podcast and talk with you, or an elevator pitch, or a networking event when you're speaking, being able to say to folks, right off the cuff, here's what I do, here's where I add value, and here's why I want to work with you.
Yeah, no, that's some really good stuff. What sort of routines and rituals have you developed that have helped make you successful thus far?
These are great questions. I love it. I've been in the military for 20 years. I was in a military high school and a military college, so I'm very regimented.
Yeah.
So if you look at my desk, I have Post-it notes and checklists and everything. So, and that has helped me in a way. It's maybe a little rigid, but at the same time, I found the flexibility and latitude to allow me to still flex my muscles. But I have a weekly checklist I keep, and it's just a Word document, and I have, everything set up on by topic. And I follow that, so that if I kind of am like in a lull or it's quiet, I just go to that and say, all right, what's on my checklist for the week? And then I constantly communicate with my partner, David, my business partner. He's down in Hilton Head, South Carolina. He's our CFO. So it's nice. He handles all the finances, the taxes, the statements for the investors. We're constantly in communication. We're constantly talking about, again, the tactical level, the operational level, and the strategic level, the way I laid that out, and just, what's on our plate. What do we have that's coming in? Most importantly, it's the investors, making sure that they're comfortable. They know what's going on. If the investors aren't bothering me or emailing me, then it's okay. What else is going on? But I'm always thinking, what do I need to make sure that the investors need to be abreast about, given a project, what's coming up, newsletters, full gamut of that. But yeah, that's how I keep on top of stuff, and it's helpful. And then obviously, calendar reminders, having, as you grow, and if there's more and you feel overwhelmed, get an apprentice or get an an intern. You can bring on an admin assistant. And again, I would recommend outsourcing that before you commit to someone as a hire. But yeah, as you start to grow, there's so many great tools. CRMs are out there. When I meet a new contact, I have an Excel spreadsheet. That's my CRM. I have 600 contacts. I put them on my distro list, and so everybody gets a newsletter. Everybody gets updates on our company. LinkedIn, Facebook, social media, you got to hit that, because you got to want to remain relevant. And by remaining relevant, people know who you are and what your business is. I sent out my newsletter last week, and I got 30 emails back from people saying, John, I got this person you got to meet. Or, hey, I need to get together with you a cup of coffee. I got these deals we're looking at. So that's where you maintain your relevance. There's other things you can do too. You can get a website and start a blog. Again, the social media buffs, we're in the informational age. There's so many things available, but the more you get yourself out there, the more you can explain to people what you do, the better off you are.
Yeah, 100%. So let's move over to that Keystone deal. So a deal that made a big impact on you and your business. Tell us about it.
Yeah, so we started up back in 2013. We had a vision of what we wanted to do, and that vision was really to work with sponsors and developers that needed equity, people that needed that down payment money, whether it was $100,000 a deal or up to $5 million a deal. And that was kind of like the niche we carved out. And we didn't really alienate. We were looking at single family rehabs. We were looking at, mixed use condo development. We were looking at multifamily, whatever kind of flavor it looked at, we wanted to do. And at that time, we had about 20 investors in the company, close friends and family, people that I worked with that came on board and were interested in seeing what we did. So at the time, we had just finished about 3 to 4 single family renovation projects. We were bringing in $100,000 to $200,000. And then the first big deal hit, where we were going to bring in $500,000 of equity to a developer that I knew real well. I served with in the Navy for over 20 years. And one of the reasons why I really wanted to start the company was because of the types of deals that he had and how we could help. So we had a single family row house in Washington, D.C. Northwest, a really great area, a neighborhood called Adams Morgan. Established, well-known, popular, great neighborhood, and in an area that this developer had done numerous projects. So checks in the block right away. Well-established neighborhood, prominent area in DC, attracting young people, middle-class people, and developer that's done numerous deals there. So great checks in the box and making us feel good about it. It was a row house that was converted to condominiums. So basically, what he did was he was going to take capital, going to get a bank debt, bring in some equity from us and from his business, and he was going to convert a 3-level home that was in foreclosure to 8 condominium units. And basically, we set this up as a joint venture between ourselves and the developer. And we stood up an entity where, as a limited partner, we brought in the money. The developer brought in the money. He would operate the project, and we would just be part of the management piece. So we were free and clear of any recourse loans. We weren't really out there every day swinging hammers and worrying about the GC coming out to the project. But at the same time, I was out there probably 3 times a week, twice a week, meeting with the developer, walking the project, taking pictures, and being the eyes and ears for my investors, because that's my job. And then every month or quarter, we would get a daily an update on the project. Where are we on the budget? What's going on? What stages of the project are we in? How's revenue looking? So again, we're very much involved, but at the same time, we're not liable. So it was about a $3.2 million capitalization. about $2.5 million on a bank loan. And it was probably about $700,000 of construction and soft costs. So our company brought in $500,000. The developer brought in about $160,000, and then the bank was leveraged for the remaining for both the purchase and for the acquisition and the development and construction of the project. So it was supposed to be about a 15-month project. And the way we set up our deals, Seth, so you know, is we set up an interest rate where we collect about 8 to 10%, and then we get what's called a waterfall, which is basically a percentage of the profit. So that's how we structure our deals. So as the entity comes in under management with our company and David and I as GPs and our investors as LPs, we then insert the entity as an LP under management. And then we get paid on that entity an interest rate and a percentage of the promote. So our goal is to get to a combined IRR, investor rate of return, of about 25 to 30% a year on our money. Okay, so in this case, we're looking at making about 150,000 on the 500 a year. So we were supposed to be in the deal for 15 months. Unfortunately, up here in DC, sometimes you get delays and you get weather. So it ended up going for about 19 months. But at the end of 19 months, well, let me go back. The deal itself was set up with an extension of the existing property to the back of the property. And so the back of the property, half of the back of the property was now new construction. And then the existing row house was just a conversion, which got us the 8 units. The units were, the lot itself was about 3,000 square feet, pretty small, but we were allowed to go up pretty high. The units were about 700 to 1,000 square feet, about 1 to 2 bedroom with 4 parking spaces for the 8 units. And they also were part of the revenue and sale. Again, it went about 19 months and about a 3.2 capitalization. And the units sold between about $400,000 to about $700,000 a piece. So that's about a $650 price per square foot, with the parking spaces selling for about $30,000 to $40,000 a piece as well. We made a gross sale of about $4.2 million out of the 3.2. So we walked away with gross about 800 to $1 million bucks, and our company made $231,000. So on $500,000, we made $231,000 in 19 months, and that came out to about a 46.3% return. And our investors were making we made about 29.5% on that annually. The investors were making about a 27.8% return, or 17.5% annually. So that was a fantastic deal. We exceeded our numbers. We projected about 16, 17%, and we went above that. And that was the first deal that launched us into the condo market, the mixed use market, and larger projects. After that project, we had another one that went up. It was a 20 unit. We brought in $750,000. Following that was another one. We brought in $1 million. Again, very large scale. So that first one really got us going. It got us comfortable with the structuring of a limited partnership, the operating agreement process, and just, getting our arms around a larger project, so that now, we've done 7 of those, 8 of those. It's kind of like, all right, to look for. And you're constantly growing. You're constantly evolving. You're making changes to your checklists, what to look for when you do your due diligence. But that one really, put us over the top and got us on the path we're at now with the type of deals we're doing.
Yeah. And because that was, the first one that got you going, what sort of challenges did you have in terms of raising the capital? Because it's always a grind getting your first one up and going.
Yeah, I think the biggest thing I would say is just not setting the bar too high, just making it reasonable, conservative, making your investors know that, look, we're going to shoot for this return. We could make more, we could make less. So, you just got to be able to, kind of capture the expectations and making it realistic. Typically on our deals, given the level of risk, we usually set what's called a preferred interest rate return. So we basically set a pref up for our investors before we get paid any money. And that on these types of deals, these larger script deals, is about 12% a year. So they're making 12% a year before my company takes any money. And of course it's deferred because you got to sell the units. But that was a challenge, just making sure that the investors were comfortable with the returns given the level of risk. The other risk, or the other challenges, is just staying on top of the project, making sure that you identified all of the risks. So when we first started out on this deal and a few others, we didn't do a private placement. So again, it was close friends and family. So we had to be very thorough and kind of informative on providing information that was non-orthodox than you would see in a PPM. As we got bigger, we just funded a $4.5 million deal in DC, and we said, you know what? To protect our investors and to protect ourselves, we need to start filing to make sure that this is done right, because now we're bringing on public investors, we're bringing people in that are public accredited, and as you grow as a business, you always got to make sure that you're doing what's right. So when you file a Form D 506, you got to make sure that everything's done properly. And we hired an attorney to do that. And all of our projects now are on that road. The small ones we started, like this one, close friends and family, it was a little easier. But as we grew, we wanted to make sure that we protected ourselves. So that was another thing. And the nice part about that is, a PPM, I'm sure you've seen a private placement. They're very, very detailed. They have the risk section, the return section, all of the details of a project. So it took a lot of pressure off of us. But at the same time, we still got to do our job. We got to make sure that the due diligence is done. We got to make sure that everything's lined up properly. So the timeline is aggressive at times. That's another challenge, making sure that you give yourself, your investors, and the developer sponsor enough time to let them know, look, I need 8 weeks from the time you send me the deal to the time I can give you a commitment on this deal on how much I can bring in. And that's when it gets busy, because you're running around doing a million different things. But when you do it a few times and you're working with the same developers, you kind of come up with a nice routine. And that changes a bit, but at the same time, at least you're comfortable and you know what to expect.
Yeah, for sure. So how has getting involved in real estate, and you were able to transition from doing it part-time to full-time, how has this impacted your life and that really changed things up for you?
Well, being in the Navy for 20 years, I was getting a paycheck every 2 weeks. So obviously taking that step forward from when I retired was a little apprehensive. I have a family, I have 4 kids, my wife, we live in a nice area. So obviously the big thing was, how do I continually take care of my family, get myself comfortable, and at the point where I feel, all right, this is something I can do full time. I think the best thing I did was I started it while I was still in, with 4 years left on my commitment to my retirement. So I could take my bumps and bruises. I could take everything I knew was coming while I was still in, learning from my mistakes. And I'm still learning. You're always learning. But it gave me the confidence to say, look, if I could do this for 4 years part-time and we've had this success, it's going to be pretty cool if I can do this full-time. That, and always putting smart people around me. I'm bringing my partner David on, who was my accountant first and now is my business partner, I think was phenomenal, because he's such a smart guy when it comes to the numbers and the money and the banking and the taxes. And so he does a lot of that for us. And that's a huge burden off of me, because now I can go out and I can really focus on the operations and growth of the company. But having smart people around you, and just going out and learning more about people and what they do, it's so exciting, being around someone and learning from them. And I think it's a blessing. I think God puts us in front of people for a reason. And it's great to meet good people that can help you, that you can help. And at the same time, it's fun. I mean, I love what I do. I love waking up every morning and coming down to my office and checking my emails and looking at a new deal, or seeing how I can help someone, or a new person says, hey, I just heard about your business from one of your investors who's a friend of mine, or he's my cousin, or he's my brother. I want to learn more about what you do. And the next thing you know, it's like, that person's an investor 2 weeks later, which is great.
Yeah.
So that's the fun part. It's exhilarating. It's full of, excitement. And you wake up every morning and you're so excited to go to work. Like I'm sure you are. And do what you do. And sometimes it's like, wow, is this really work, or is this just, having fun? So that's what I love about the business. And, there's ups and downs. There's always what happens if something happens to the economy? Am I going to still, hey, that's just part of life. You just got to be ready to go and be prepared.
Yeah. And you're still growing, doing bigger and bigger deals. Looking ahead, let's say 10 years from now, where do you see yourself in your business in a decade?
That's a great question. Look, if we can continue to have the deal flow we have, continue to grow with the sponsors we work with, and then maybe just kind of continue to grow as a corporation where we bring in more people. In 10 years, I mean, I'd love to have an office where we have 5 or 6, maybe 10 advisors working with us, and we're looking at deals through the business. I'm also really interested in maybe starting an investor club at some point down the road with very, very close friends and family and people that I work with, where we all get together and we look at different opportunities. So, look, I don't know if I can look that far out, but at the same time, I just say, hey, I like what I'm doing. I enjoy what I'm doing. And if I could be doing this now what I'm doing now in the next in 10 years from now, and we're having the growth and we're doing well, we're successful, then I guess that's my 10-year vision.
Yeah. Well, we'll be talking in 10 years about your, $100 million deal that you raised for.
That would be great.
Yeah.
I love that.
Yeah.
Yeah.
That's great. Well, John, if somebody's looking to get in touch, learn more about what you're doing, learn about your company, where can they find you?
Yeah, absolutely. So you can come visit us on our website. It's just www.jidinvestments.com. We have a lot of good information on there. You also can find out about our investment services, our funding services, our current and completed projects. And then they can also reach out to me anytime on my email. It's just my first initial, J as in John, my last name Rubino at jidinvestments.com. And if you go to our website and you click on the contact tab, you can also find my information. So I'm on social media. I'm on LinkedIn. I love LinkedIn. I post a lot of good information. So if any of your listeners want to jump on our mailing list and learn more about what we're doing, we just released our 2019 mid-year newsletter, and it's fantastic. I've gotten nothing but wonderful, wonderful feedback from investors and colleagues. That's gone out to about 3,000 people. And it's just great to be able to share. So that's probably the best way to get a hold of us.
Yeah. Good stuff. Well, John, just want to say thanks so much for taking the time today and sharing that deal and the good tips with us.
Thank you, Seth, for having me. It was an honor and a pleasure. I appreciate it. And I look forward to keeping in touch. Let's do some more of these. This has been a blast.
Yeah, pleasure was all mine. And to you, our viewers, I wish you well on your journey from purchase to profits. See you next time.